The silver market just experienced something absolutely unprecedented. And if you're not paying attention to what happened, you need to understand this right now because it's affecting every single person who owns silver, is thinking about buying silver, or has any exposure to precious metals whatsoever. We're talking about one of the most dramatic price swings in the history of commodity trading. And at the center of it all, according to the US Treasury Secretary himself, are Chinese traders who essentially broke the silver market. Let me paint you a picture of what just happened. On January 29, 2026, silver hit an all-time nominal high of $121.67 per ounce. Think about that for a second. Silver, the metal that was trading around $32 just a year earlier in February 2025, more than tripled in value and smashed through the psychological $100 barrier for the first time in human history. People were calling it the Silver Squeeze 2.0, reminiscent of what we saw back in 2021, but on absolute steroids. The excitement was palpable, retail investors were pouring in, social media was exploding with silver content, and everyone thought we were witnessing the beginning of a new era for silver. But here's where things get absolutely wild. Within just 2 weeks, the market completely reversed. We're not talking about a gentle correction or a healthy pullback. We're talking about a catastrophic sell-off that wiped out nearly 50% of silver's value in a matter of days. By February 14th, just 16 days after that historic peak, silver had crashed down to around $78 per ounce. Imagine if you bought at the top, maybe you got caught up in the hype, maybe you thought silver was going to $200, maybe you leveraged up thinking this was your ticket to financial freedom. You would have watched half your investment evaporate in 2 weeks. That's not a correction, that's a wipeout. So what actually happened? This is where it gets really interesting because we're not dealing with speculation or conspiracy theories here. U.S. Treasury Secretary Scott Bessent came out publicly and attributed these extreme swings directly to speculative activity, particularly from Chinese traders. Now, when the Treasury Secretary of the United States specifically calls out Chinese trading activity as the cause of a commodity market breakdown, you need to pay attention because this isn't some random market commentator. This is someone with access to actual trading data, flow information, and intelligence that regular investors simply don't have. The Chinese silver market operates differently than what most Western investors are used to. In China, there's been an explosion of retail trading in commodities, and silver specifically became incredibly popular among Chinese retail investors and traders. We're talking about millions of individual traders, many using significant leverage, all piling into silver futures and spot contracts simultaneously. The Shanghai Gold Exchange and other Chinese trading platforms saw absolutely massive volumes during this period. When you combine aggressive retail participation with high leverage ratios, you create the perfect conditions for a speculative blow-off, which is exactly what Bessent called it. But it wasn't just speculation driving this move. There were real fundamental factors at play that gave this rally legitimacy in its early stages, which is what sucked in so many smart investors who normally wouldn't chase parabolic moves. The silver market has been in a supply deficit for the past 6 years. That's not speculation, that's documented fact. Above-ground stocks have been depleting, and this wasn't some gradual thing. The pace of depletion was actually accelerating. Industrial demand, which represents about 60% of annual silver consumption, remained incredibly strong, particularly from the solar panel industry and electronics manufacturing, where silver's unmatched conductivity makes it irreplaceable. Then you layer on top of that the geopolitical and economic factors that were emerging in late 2025 and early 2026. Tariff policies were creating uncertainty in global supply chains. There were regional dislocations in silver production and shipping delays that were causing real tightness in physical markets. Silver was literally being stockpiled in American vaults as traders and investors anticipated supply disruptions. The lease rates, which measure the cost of borrowing silver for short-term delivery, jumped over 30 times their normal levels during periods of acute stress. When lease rates spike like that, it signals genuine tightness in the physical market, not just paper speculation. The monetary policy backdrop was also supportive. U.S. economic data started weakening significantly in late 2025. December retail sales unexpectedly stalled. The GDP control group, which is a key indicator for actual economic activity, fell 0.1%, and confidence in U.S. assets was deteriorating. Markets began pricing in approximately 60 basis points of Federal Reserve easing by the end of 2026. When real interest rates are falling and the Fed is expected to cut rates, precious metals typically benefit because the opportunity cost of holding non-yielding assets decreases. So you had this perfect storm where legitimate fundamental factors created the initial upward momentum. Chinese retail traders with high leverage amplified that momentum into a parabolic spike. And then when profit-taking started, that same leverage worked in reverse, creating a cascading liquidation that took silver from 121 all the way down to the mid-70s in just days. It's a classic speculative cycle, but the speed and magnitude were unprecedented in modern silver trading history. Now here's what's really important to understand about where we are right now. As of February 15th, 2026, silver is trading around $78 per ounce. Yes, it's down dramatically from that 121 peak, but let's put this in perspective. Silver is still up over 135% from where it was just 1 year ago. It's still trading more than double its historical averages. The fundamental factors that supported the initial rally, the supply deficit, the industrial demand, the monetary policy backdrop, none of those have changed. What changed was the removal of the speculative excess, the leverage positions getting flushed out, and the market resetting to a level that better reflects underlying fundamentals rather than pure speculation. The market has been trying to consolidate in the $75 to $85 range over the past week. We saw silver bounce to $84.72 on February 11th, up almost 5% in a single day, which shows there's still buying interest at these levels. By mid-February around the 12th, prices had stabilized around $83 as the dust started to settle, and cooler heads began evaluating whether this represents a buying opportunity or if there's more downside ahead. Professional analysts are weighing in with their views. JP Morgan Global Research released a forecast seeing silver prices averaging $81 per ounce for 2026 overall, which is more than double the average price from 2025. That's a major investment bank with sophisticated modeling telling clients they expect silver to hold most of its gains throughout the year, despite the recent volatility. Their analysis is based on the structural supply deficit continuing, strong industrial demand persisting especially from solar and electronic sectors, and the Federal Reserve easing cycle providing tailwinds for precious metals broadly. The gold to silver ratio is currently sitting around 50 to 1, which is historically quite favorable for silver. For context, in recent years this ratio has ranged anywhere from 70 to 100 ounces of silver per ounce of gold. With gold now trading above $5,000 per ounce, a 50 to 1 ratio suggests silver has room to appreciate relative to gold if historical patterns hold. When this ratio is compressed like it is now, it typically indicates either silver is fairly valued relative to gold or gold is due for a correction. Given gold's continued strength, many analysts view this as supportive for silver maintaining elevated price levels. So what happens next? This is the million-dollar question that everyone wants answered. Let me give you several scenarios, because anyone who tells you they know exactly what's going to happen is either lying or delusional. Markets don't work that way, especially after the kind of volatility we just witnessed. The bullish case remains intact despite the crash. If the supply deficit continues and industrial demand holds up, there's a fundamental floor under silver prices that's significantly higher than where we were a year or two ago. The solar industry alone is expected to consume massive quantities of silver over the next several years as the green energy transition accelerates globally. Every solar panel requires silver, and there's no economically viable substitute for many applications. If the Federal Reserve does cut rates 60 basis points or more as markets are currently pricing, that's historically been very positive for precious metals. Safe haven demand could return if geopolitical tensions escalate or if confidence in fiat currencies continues deteriorating. The Chinese traders who caused the spike are largely flushed out now, which means we've removed a major source of instability from the market. A consolidation phase around current levels, followed by a grind higher toward $90 to $100 by year-end, is entirely plausible under this scenario. The bearish case focuses on the damage done to market psychology and the potential for further liquidation. Leverage is a double-edged sword, and there could still be leverage positions that haven't been fully unwound yet. If we see another wave of forced selling, silver could test the $70 level, or even drop into the mid-60s if panic sets in. The rapid spike and crash has created a generation of bag holders, people who bought near the top and are now sitting on massive losses, and they represent potential supply as they look to exit on any bounce. If Chinese regulators crack down harder on commodity speculation, which they've done in the past, that could remove liquidity from the market and lead to more volatility. Global economic growth could disappoint, reducing industrial demand for silver and undermining one of the key pillars of the bull case. In this scenario, we could see silver drift lower throughout 2026, potentially retesting the $50 to $60 range. The most likely scenario in my view is something in between. Markets rarely move in straight lines, and after violent moves in both directions, we typically see choppy, volatile consolidation before the next major trend emerges. Silver will probably continue trading in a wide range, maybe between $70 and $95, for the next several months, as the market digests what happened and evaluates the true supply-demand balance without the speculative distortions. We'll likely see sharp moves in both directions that shake out weak hands and frustrate traders trying to catch quick moves. But over the medium term, the fundamentals suggest a bias toward higher prices, just not in the parabolic fashion we saw in January. What should investors actually do with this information? If you're holding physical silver that you bought years ago at much lower prices, congratulations, you're still way ahead even after the crash. Don't panic sell into weakness if your thesis hasn't changed. If you bought near the top, you need to make a hard decision about whether you believe in the long-term case, enough to hold through what could be an extended consolidation, or whether you need to cut losses and move on. There's no shame in admitting you got caught in a speculative blow-off. If you're looking to get into silver now, the current levels are far more rational than 121 was, but don't expect smooth sailing. Dollar cost averaging makes sense in volatile markets like this rather than trying to time a perfect entry. The professional guidance from financial advisors typically suggests no more than 10 to 15% of a portfolio should be allocated to silver specifically, with total precious metals exposure including gold capped around 20%. That's not because silver is a bad investment, it's because concentration risk in volatile assets can be devastating, as we just witnessed. Diversification isn't sexy, but it's what keeps you in the game when markets go crazy. One thing is absolutely certain, though. The silver market will never be quite the same after what just happened. We've seen what happens when massive leverage meets thin markets and strong fundamental tailwinds. We've seen how quickly sentiment can shift from euphoria to panic. We've seen how interconnected global commodity markets are, and how trading activity in one region can impact prices worldwide. The Chinese traders didn't just break the silver market temporarily, they revealed just how fragile and susceptible to manipulation commodity markets can be when speculation overwhelms fundamentals. The next few months will be critical for determining whether silver can rebuild trust with institutional investors who got burned, whether retail investors will return after getting crushed, and whether the fundamental case is strong enough to support prices at these elevated levels without speculative fuel. Pay attention to lease rates, watch for any changes in industrial demand data, monitor Chinese regulatory actions around commodity trading, and keep an eye on Federal Reserve policy signals. Those are the factors that will determine where silver goes from here, not social media hype or predictions of silver going to $500. This is a market that demands respect, demands risk management, and demands that you separate emotion from investment decisions. What happened with Chinese traders breaking the silver market is a lesson that will be studied for years to come. And if you're invested in silver or thinking about it, you need to understand these dynamics because they're not going away. The fundamentals remain supportive, the volatility remains extreme, and the opportunity for both gains and losses has never been higher. Trade carefully, invest wisely, and never forget that markets can remain irrational far longer than you can remain solvent, especially when leverage and speculation enter the equation.